Richard Lacaille, Chief Investment Officer with State Street Global Advisors, one of the world's biggest institutional fund managers, is also among those cautious about an Asian recovery. He says Asia is still too dependent on the U.S. economy. State Street has about $1.9 trillion under management, and Richard joins us from Hong Kong this morning. Richard, your thoughts on that? Is China going to crash within the next 12 months? And some say it is on a treadmill to hell.
We don't think it's going to crash in the next 9 months. We think there's certainly room for slowing down the Chinese economy. It's running at a pretty rapid clip right now, having had a real sharp V-shape in terms of its recovery. But investors need to distinguish between the kind of signal and the noise. They need to think about the long-term growth story for China and Asia and not get too distracted by, these fluctuations in valuation that you often see.
What should they be doing? Buy into weakness right now?
Well, we've been a little bit cautious on the larger countries in emerging markets, China amongst them, that seem to have reasonably rich valuations. It doesn't really detract from the long-term growth story, but sometimes there are better opportunities in some of the smaller markets than the larger ones. And that's true right now in this region.
What do you make of Chinese banks? I mean, how real are concerns when people say, be careful about NPLs? I mean, some people like Jim Rogers have come out to say that.
Well, people talk about credit risk wherever you've got very rapid credit creation. There were good reasons for rapid credit creation in terms of the fiscal and monetary stimulus needing to take place in order to get out of that hole that we could have been in the beginning of 2009. And that process has worked. And now you move on to the second stage of the whole challenge that we're facing in the global recovery, which is how do you keep it at a reasonable pace? And I think that issue of looking at reserve requirements and ultimately potentially hiking rates is got to be on the agenda.
You're cautious about China. Are you as cautious for the other emerging markets? We spoke to Antoine van Akmal, who coined the term emerging markets. He says emerging markets will take a breather in 2010. Do you agree with that view?
They're certainly not cheap markets, and the larger ones, as I mentioned, China, there's a few others that we think are quite richly valued right now, like Brazil. We can be a little bit underweight in those, but still be enthusiastic about emerging markets in the long term. And again, I think the theme is to sort out these short-term noise signals from the long-term story in emerging markets, which in terms of growth and in terms of corporate earnings still remains very strong. So I think if we're going to make any sort of tactical underweights, they're short-term.
Right. If there is one emerging market you recommend, what would that be?
Well, as I said, there's a number of the smaller emerging markets in the region. Indonesia and Philippines will be examples where they may benefit from this long-term growth story and, in fact, continuing China's strength, but maybe a little bit cheaper.
Okay, let's turn to Greece. I mean, that's a focus for markets right now. 3-year lifeline for Greece. Does that change your view of the situation and the possible spillover for the rest of the region?
Well, it's an important liquidity development, but investors are going to look to see how that austerity package works out in terms of getting Greece onto a sustainable path in which their debt to GDP ratio and the annual budget deficit or surplus is manageable. And at the moment, that's just unclear. So I think we may see a continuing high spread and volatility in the spread over the first part of that 3-year period while investors evaluate.
How high is that risk of contagion?
Well, I think the contagion there's two types of contagion. One is risk aversion. We've already got a lot of risk aversion amongst sovereign risks in the periphery of Europe and elsewhere. So investors evaluate the same risk in a different way and need to be rewarded more for it. And I think that's natural. That's part of the capital markets in terms of pricing risk. The contagion when it comes to default probability is a different issue. Is it more likely that Portugal, Spain, or some of the other markets that people are looking at are more likely to default simply because of what has happened with Greece? We don't think so. So people have got to, again, look through the noise to the underlying signal. What are Portugal's finances like? How have they dealt with their need to put in place an austerity package? And I think on that conclusion, you'd say that the risk aversion will be a short-term phenomenon, but we may get back to a normal pattern where it really hasn't been a contagion.
When you look through the noise, what are you doing with your investments? You're still favoring stocks over bonds, correct?
We're still favouring stocks over bonds. We're still favouring investment-grade credit that we think has got some scope, albeit limited, to tighten. And that's basically because we think the global recovery is intact. So corporate securities are looking reasonably valued compared to many long-term averages, and for that reason we're comfortable being a little bit overweight. And yes, there will be potential buying opportunities where you've got these dips where risk aversion rises, but the long-term picture, we believe, is supportive of corporate securities.
Can you be more specific on what you like in particular? What stocks, what sectors, what are you looking at?
Well, in terms of regions, we're a little bit more overweight in Europe than we are in the US or Asia Pacific. Again, on valuation grounds, Europe's trailed from an economic perspective. People have drawn conclusions about the trailing effect on stock markets. So we're a little bit more overweight in Europe than we are in other places around the world. We still have a small overweighting in emerging markets relative to developed markets. And we've got a small weighting to international small cap outside the US.
Okay, Richard Lacaille, State Street Global Advisors CIO, thank you for your insights on Morning Call.